Hi there. Now, recently you may have heard all about this GameStop thing in the news and about how the internet took down Wall Street. But what was it all about? Let me explain. You already know that investors can make money by buying shares or stocks, it's the same thing, which then rise in price. They sell them on, making a profit. But they can also make money by selling shares that fall in price. How does that work? All right. So to explain, I'm just going to move away from shares just to simplify it slightly. All right. So let's imagine that you have borrowed a brand new pair of trainers from your friend and they are worth £100. Now you decide to sell those trainers to a market seller for £100. You do this in the hope that with the release of a new line the brand are releasing the next day, those trainers are going to decrease in value. And guess what? Your hunch proved correct. The next day you go to the market and you see the same pair of trainers that you sold for £100 yesterday are now £60. So you buy them back. You've made a cool £40 profit overnight, so simply, so easily. But it's a risky strategy, right? Because you have to give back a similar pair of brand new trainers to your friend no matter what happens. So let's say that the new brand that was released the next day is ridiculed. Nobody likes it. Everyone wants to go back to the original type of trainer. Demand increases, so the market seller can up their price. You go to the market the next day and that same pair of trainers are now £140. Now you need to buy them back to give to your friend, but that means you have just lost £40. Now this is what some people do with shares. They borrow them and then they sell them at one price in the hope that they can buy them back at a lower price. This whole process is called shorting or short selling. All right. Investors, what they are trying to do is work out whether the current share price reflects what is likely to happen in the future. In other words, if an investor believes the future holds bad news for a company, but their share prices don't reflect that yet, they could short those shares. So here's where GameStop enters the mix. Now this is a high street shop, you find it in shopping malls, it's not an online commerce. So with the increased popularity in online shopping, GameStop profits have been slowly but surely decreasing over time. All of a sudden you enter a worldwide pandemic into the mix and forced closure of their stores. And some investors thought that they had a business here that was guaranteed to fail. And if a business is going to fail, their share price is going to fall to next to nothing, okay? So a number of investors borrowed stock, sold, and waited for the business to fail so they could buy the shares back at a really, really low price. But instead of doing this with just £100 like with the trainers, these investors did it with millions and millions of pounds. That's one group of investors. Enter the surprise second group of investors. Now, these were people on the website Reddit who realised what was going on and they wanted to make some money themselves. And they also wanted to play with the system a little bit. So they decided not just to buy the stock, but also encourage others to buy the stock too. And Redditors did so in their thousands. The more people who wanted to buy, the higher the demand, and therefore the higher the price of each stock or share. Stock value doubled and then tripled within a week. So go back to those first investors who had planned to short. Suddenly, they faced this massive decision. Their stock was at a much higher price than they had sold it at. Now, they could either buy it back, lose a lot of money, or wait it out in the hope that this decreases. But that's a bit of a high risk strategy, right? Because what happens if it just keeps on going up. So many investors decided to close their short position, essentially buy it back. That meant that the stock price just continued to go up, and that each of those investors who brought their stock back lost hundreds of millions within a week. So that is the GameStop story. It's these online amateur investors beating Wall Street at their own game. It's raised so many questions about fairness, about a need for more regulation, about how accessible investment options are for the likes of you and me. As a word of warning, I really should put in there that those Redditors that were investing in this instance, they didn't all make lots of money. Indeed, many lost money because those share prices went up and down quite drastically in a very short space of time. All you need to know is that investment is always a risk, whether you are a full-time investor on Wall Street, or whether you're just having a punt on your laptop or an app on your phone. You just need to understand what it is you're doing and what the potential consequences are of the investment that you want to make. Now, there is sure to come more from this story. Maybe there'll be a change in how investors can short, or in how amateurs can interact with the market. Either way, it's a really interesting time to learn about investment and what is possible for you.